I can see it's a jammed audience. Okay, let's get this show on the road. So many thanks to Kai and the Goldmesse team for having me present today. It's a very nice change to be here in person versus my last presentation, which was in a virtual environment. I must say that I have a hard act to follow, having sat in some of the keynote presentations over the last 2 days, which were absolutely superb, by the way. And I'm not talking about inflation, so we're segueing into something different, but I have to say that I haven't published a book, and nor do I have a significant following on Twitter, possibly because I'm not on Twitter. So, so we're going to have a little bit of an audience participation here, and so I'm going to be participating along with you, so no groans please, but how many of you have had a realised investment when you've been down 10% or more? Raise your hand. Let's all be honest here. 20% or more, keep your hand up. 50% or more, keep your hand up. Ooh, this is getting to the embarrassing part of the polling. Who has had an investment where they've been down 100% where they've lost their principal? Anyone? Am I the only one? Or I'm the only one that admits to it?
It's like 99.
99.9? Well, I owned a company that went bankrupt, so I've hit that magic 100% mark. I think that makes me a winner in this polling situation, or a loser, depending on your point of view. So this presentation is on what I think is the under-focused part of the investment process, and that's the selling side. So remembering to sell and the hard work of selling. I have been on this side of the business for in excess of 19 years, and it's my observation that investors of all stripes, from institutional investors through to including high net worth retail and low net worth retail, the most difficult part of the process is this making the decision to sell and when to sell. So why is making that sell decision so incredibly important? If you don't sell at the right time, you have the potential for catastrophic losses. And none of us want to be that person in the bathroom crying, saying, please make the pain go away. So I think a pretty good example of a catastrophic loss, but one that occurred over an extended duration, is what we recently experienced. All of this room, we're all of a reasonable age, that we were probably exposed to the gold sector during the bear market from the peak of August 2011 through to the bottom or the depths of despair of December 2015. So this chart shows on a relative basis the performance of gold versus the two main ETFs that we track our sector with. The juniors in the form of the GDXJ, represented by the grey line, and the seniors in the white line. So just as a reminder how horrific those 4.5 years were, is the GDXJ was down 87%. The GDX, obviously slightly lower as companies, was down 77% during the same time frame. And if we look at the performance of those funds that were public during this same duration, not only did many of them perform in line with the GDX and the GDXJ, they didn't outperform, some of them underperformed those two benchmarks. And so again, why is the sell side of the investment decision-making process such a difficult one to get right? Just a chart to further illustrate that point, and I like to, rather than subtly suggest a point, I don't see the point in doing that, you just want to pound it home. I have a chart here showing when you are down a certain amount, what relative performance you need to have to get back to zero, to get back to your principal. And there's an exponential parabolic effect. The more you drop, obviously, the higher the percentage it takes to get back to your cost basis or to zero. So if we look at what was the approximate downward performance of the GDXJ during the bear market, it was around 90%. And that's a really startling number to get back to zero. It's 900%. We live in a sector that we're in because of the potential for explosive returns. And I think we've all talked about our desire to have 10 baggers. And I think we all know that 10 baggers in actuality are pretty rare beasts indeed, unfortunately. So as I was reflecting on putting this presentation together, and I find these presentations kind of useful for myself as well because it forces me to coalesce my thoughts in hopefully what is a reasonably clear thesis on the other side. I think that we tend to be less good at the sell side of the investment decision-making process due to the irrationality and emotion nature of our species. And I think we can put this down to three main psychological traits or biases, whatever you want to phrase these as. And there are a huge number of experts that have written on this. There's academic papers, there's lots of books, obviously there's Twitter memes, etc. But despite all of this wealth of knowledge, I think we still find it hard to get this right. And I would say there's three main reasons for this. Anchoring endowment bias, greed drivers, which are particularly prevalent in a bull market and relevant to the market that we're experiencing today, and loss, regret, aversion. So anchoring or endowment bias, what do I mean by that? I think possibly one of the best examples of anchoring bias was what we recently experienced with the global pandemic. We essentially had global catastrophe. Instead of everybody running out to buy gold and guns, which you think might be the rational response, toilet paper became the value proposition. I'm embarrassed to say this particular video was from Australia. There were numerous examples of Australians fighting over toilet paper. I'm not sure what that says about us. I don't think it says anything good. So if we talk about what anchoring bias is with respect to investing, a good example is if you pay $1 for a share, if you decided to invest in a company, you equate that value that you paid, that price that you paid with value. And these are two very, very separate things. So what happens if that share price declines 50%, and we're all guilty of this? We say, well, it's going to retrace back to fair value because we've decided that fair value is the price that we paid. Fair value might actually be 50% less than the current decline that we've just experienced. Endowment bias is another good one that's particularly relevant to investing in our sector, and that's when you own something, you value it much more highly than an equivalent something that you don't own. For example, if we had two juniors that had a very similar investment profile and you owned one of them, you have a propensity to think that that one will perform better than the one that you don't own. Just on the subject of value, my experience in this sector is that I don't believe in efficient markets over the short term. If markets were truly efficient, we wouldn't have opportunities to make outsized returns or outsized disappointments, as the case may be. I think that value expresses itself over the long term. And so ultimately, at the end of the day, it doesn't matter what you think the value is, it matters what the rest of the market thinks. And so we have very influential individuals in our space, whether that be newsletter writers or Twitter pundits or famous investors such as Rick Rule and Eric Sprott. Now, they can come out and be very positive about a particular story, and obviously investors rush in behind them based on a value proposition that may or may not be there. And so just to be aware when an influential pundit opines on a particular investment, there is commonly downside risk as well. Now, moving on to greed drivers, and this I think is particularly relevant to the cycle that we're currently in. That is at the beginning stages, not quite, but at an emerging bull market. And what tends to happen in an upward moving price environment is if we've done well in performance on a particular share, particularly in a bull market, we tend to believe that that's our genius approach to investing versus the fact that a rising market floats all boats, and obviously, oppositely speaking, a receding tide not only strands ships, sometimes tips them over and destroys them. And so we have this propensity in a rising environment to try and squeeze the last value out of that dollar, and that then drives our selling behaviour, sometimes to our detriment. In terms of loss, regret, aversion, I think this is a really interesting one. Studies show that most people are 1.5 to 2 times more likely to sell a losing position too late. And the best portfolio managers across all sectors, statistically, are those ones that decide to sell their losing positions the earliest. And so what happens is if you're down a certain percent, you again have this natural reaction, well, I bought it at X, that's the inherent value, it's going to retrace back to that position, rather than being objective and stepping back and going, what is the value of this asset, and is it time to make a sell decision? Perhaps another way to look at this, a theoretical performance of a company over time. Say you bought here. Here would be a sensible time to sell, but I would say most people struggle with selling here for the fact that their anchoring bias has shifted. It's shifted from the point with which they purchased it, which was at a much lower price than even, and then you start hearing words like V-shaped discovery, V-shaped recoveries. And obviously, if all stocks had V-shaped recoveries, none of us would be sitting here today. We'd be in our mega yachts in the Mediterranean. So again, it's where do you anchor your price expectations and your value expectations that dictates when you sell. At the end of the day, how do we deal with these inherent biases that exist in our industry and that are predominant in our investing behaviour on the buy side, and I would say even more strongly on the sell side? At the end of the day, you have to do the hard work when you're making an investment. So it's not just about maximising your gains, it's about minimising your losses. Now, as I think through my approach, and I suppose this is an approach of having made enormous mistakes, I think most people in our industry don't admit to their mistakes, giving kind of a fake view of the ease with which you can make money in a highly volatile sector. The first thing that you have to do is understand your investment. In fact, before you make a position, you should be understanding the key triggers of what your exit will be before you make that actual investment. And by that I mean, first of all, understand where you are in the cycle, understand the company, understand what the specific catalysts are that you think will drive share price performance, and most importantly, record those key investment theses points. And I think this is a really important part because we tend to retro-rationalise our decision-making process. And so having the discipline to write down why you're making a particular investment can really help you as you go through the decision-making process around selling. This is the part that requires the most effort. And look, if you're not willing to put the effort in to monitor your investment, you probably shouldn't be investing in the sector. This is one that I have, of course, been guilty of. And what I mean by monitoring your investment, if you made a position in a company, read the press releases, read their presentations, watch company management give interviews. We live in this virtual world. There's an enormous amount of information online. So just keep abreast of what's happening at a company level, what's happening in the country where that company's flagship asset or assets are. Be aware of what's going on at a jurisdictional level. And also be aware of what's going on in terms of some of the players that might be around that particular company's project. We, rightly or wrongly, we live in a world of contagion, so we tend to have, if a good event happens to a particular company, you tend to see positive feelings trickle into those companies with assets nearby, and vice versa. Now, when I look at that 100% loss that I've had, and I think it was only me and one other person in the room that's at 100% loss. That was a bankruptcy situation. And I had that loss simply because I wasn't doing the work. I had changed jobs, I was working for a fund, it was very difficult to buy and sell investments. And because of that difficult nature, I just forgot about it. And it sat there in my account for 6 months and went to zero. Now, there's no excuse for that. There really isn't. And if you struggle to understand companies well, you don't understand the press releases, you don't understand what might be driving, my voice is breaking, what might be driving share price performance, try and get advice from someone who does. And there's a plethora of those mechanisms out there, whether it be newsletter writers, etc. But just be aware that their interests and their incentives may not be aligned with yours. I mean, we know some newsletter writers receive cheap stock, they receive payments, etc. And if you're not willing to do the work, you're not willing to track your investments, you don't really understand the sector, I would suggest putting your money with someone who does. And this is the final part of the process to help you on the sell side of the investment decision-making process. You have to manage your investment. And by manage your investment, I mean every time you look at an investment, You need to decide whether you're going to continue to hold it. You need to decide whether you're going to buy more, or you need to decide whether you're going to sell. And you don't have to sell it all at once. And particularly in a rising environment, I'm an absolute advocate of taking money off the table. Nobody was ever killed for selling too early, possibly for selling too late. And as I was working through this presentation, I realised that the acronym for my strategy is I'm pretty sure that's not going to take off, but nonetheless, we're going to stick with this theme. I just wanted to talk a little bit about a recent investment that I made that is topical and the process that I went through in making that investment and how I'm thinking about monetising or selling that investment currently. So Pretium, we're all aware, Newcrest just made a premium bid, albeit a relatively small premium bid for the company last week. And I made a decision to buy Pretium about 4 months ago. And the reason that I made that decision was at the moment in our sector, we're in the time of the cycle where M&A is focused on the low risk acquisitions. And so we're seeing producers acquiring other producers, and those producers tend to have tier 1 or tier 2 assets in relatively safe jurisdictions. And kind of I was taking that theme and thinking, well, what out there could be of interest? And the larger companies were less so because we're seeing this pattern of mark-to-market mergers. And so when I looked at Pretium, I thought, well, it will be on an acquirer's list. It's a tier 1 asset. It's in a tier 1 jurisdiction, which is Canada. It has the hallmarks of something that would be desirable. And even more compelling was with the injection of the new management team last year. They've stabilised operations. They have been producing quarter on quarter in a more predictable fashion, in a grade that's hovering around reserve grade, which has always been the big concern about Pretium. And so I felt like the company had moved up the desirability curve. In confluence with that, they've been releasing some great exploration results, I think helping prove that Bruce Jack isn't just a deposit, it's part of a wider mineralised system, and they have a large land package. I mean, obviously Newcrest came in and made the acquisition. I would argue that they have gotten it very cheap, and I've made the decision to continue to hold Pretium because I think there's potential for a competitive process, number one, and I think there's potential for some investors to be unhappy about the implied price that's been paid, particularly as the company has been de-risked. We're in a stronger gold market. Obviously, if you're a gold investor, you feel fairly enthused about the commodity price, etc. And so I've just recently gone through this process myself, and I would say over the last 19 years, I've become a lot more disciplined about how I manage my own investment process. So I used this slide in the May presentation, and those of you who haven't seen it, I recommend that you do, particularly because I have a competition with Ross Beatty as to who can get the most views. He's unaware of this competition, so I think I have an advantage, and he's 360 views ahead of me, not that I look every day. And so get cracking, people, go watch that presentation. So I looked at this slide in the context of how to help make a buy decision, and I think it's also really relevant in helping how to make that sell decision. Of course, the most important ingredient is where are we in the cycle? Obviously, if we're in a bear market or a downward trending commodity market, you probably shouldn't be exposed to the sector in general. It's obviously very difficult for companies to have alpha events that perform above and beyond a general trajectory in a commodity cycle. This is my personal motto. People is the absolutely most important ingredient in making a decision to buy and to sell. Poor management teams can destroy value in a good asset, and great management teams can extract enormous amount of value out of a mediocre asset. So when I'm trying to make a decision about whether to sell, one of the first things I look at is the people. And I suppose some of the warning signs from my perspective are, has there been a change in leadership? And I don't just mean a change of the CEO. Is there rotating changes in the C-suite? That's normally not a positive sign. Have there been a number of directors that have resigned? One, if there's a reasonable explanation around it, I don't think that's an issue at all. But if you're seeing a pattern of directors resigning, that's obviously not a good thing. And I say this is another motto of mine. I've got two key ones. Trust is the rarest commodity. And so the other thing that I look at when I'm looking at the people side of things, I'm looking at what did they tell me they were going to do, and have they actually executed on doing that? And if they haven't, clear warning sign. Obviously, project is critical as well. So it's not just the attributes of a specific project that they might own, it's those exogenous events that might impact the value of the project. So if I have a big position in a particular country, I make sure I'm aware of what's going on at that country at a political level. Obviously, we've seen an increase in political risk recently in Chile and Peru that have perhaps changed the investment mandate in those two, the investment desirability of those two countries, because there is a reasonable prospect, or the market thinks that there's going to be an increase in taxes and royalties. Has there been an increase in security risk? Obviously, this is something that's of particular concern in Burkina Faso. Is there NGO activity? I just sign up to local news sites and use Google Translate. It's a great tool. So for example, there's some companies in Brazil that have got enormous issues at the local level, and it's not yet percolating into the Canadian or the international media. I look at things at the project level. For example, if they were drilling, have the drill results met my expectations? If not, why? I look at, has there been technical challenges that perhaps I wasn't aware of? For instance, is there some metallurgical test work that's worrying? Are there some mining issues, some fundamental technical issues that might maybe be concerned about holding an investment longer term? I kind of covered this in the people side of things, but again, very few companies do this well. It's pretty simple to build trust with the investing community. Do what you say you're going to do. And so just reassessing their business plan, does it make sense in the context of where we are in the cycle? Because obviously your ability to raise capital and the price at which you can raise it, et cetera, can dictate the executability of your business plan. Promotion, this is probably more important with a particular class of companies that are normally very junior, and they're really more focused on mining the market rather than adding value via putting exploration dollars or development dollars into the grounds. Now, I'm not saying you can't make a lot of money out of these companies. They tend to be, I don't tend to be attracted to them. That's not the area that I want to invest in. But some of these have exceptional performance in the short term because they get a bunch of promoters behind them. However, if they don't back that up with a catalyst that's positive, you also see a fairly dramatic and quick response on the downside. So just be aware of the style of company and the promotion. Cost of capital, I think it's worthwhile dwelling on this because we've seen some incidents of this recently. The things to be aware of are the companies serially issuing equity, particularly if it's smaller amounts at ever smaller prices, reduced prices. That's not a good sign. Or one particular example that I can think of recently, they issued equity at a 34% discount to the previous close. That, in my opinion, is a sign that things aren't going well. We've also had this pattern more recently of junior producers that have a reasonable amount of the debt on the balance sheet, and they've had operational challenges. Now, I've had visceral experience with this. I stepped up from a non-executive director to CEO of a company called Bedell that had an operating gold mine in the Northeast Amazon, and it had serious issues. I got the job basically because nobody else wanted it. And the foundations of the asset were good, but it had a huge amount of debt on the balance sheet and it had serious operational challenges. And we did a small equity raise. And when you're in this environment where cash is stretched, what you're doing is deferring paying your suppliers. You're basically loaning money from your suppliers. And it was startling how quickly that initial capital raise went out the door. And so my observation of some of these smaller producers is, and it's something to be aware of and be very concerned about, is you have a lot of debt on the balance sheet and you have operational challenges. Normally the value of money that needs to be raised is a lot higher than the market believes, and maybe even that the company is acknowledging to itself. So again, be very concerned of these. And just remember, as an equity investor, you're at the bottom of the queue when it comes out handing the goods in a bankruptcy situation. And of course, catalysts, it's the last one. Did the catalyst deliver as I thought they did, as I thought they would? If they didn't, why not? And again, potentially an indicator that you should be lighting up. Another slide that I used in my last presentation, I Obviously, I've become a little bit lazy on slide preparation. This is not my idea, but I actually think it's a superb one, and it's done by Lion Selection, a fund group out of Australia, and it's called their Lion Mining Clock. And it's relevant to making decisions on the buy side and the sell side. I think the clock is a little bit misleading. It really should be a Salvador Dali drooping clock, because each of the time periods is not equitable in nature. So you can have between 1 and 2, for instance, take 2 years or 3 years or 2 months. But we've just recently come out of a bear market, classic behaviour of a bear market. Things started to get interesting when we had lots of asset sales from majors. Majors are very, very good at selling at the bottom. It's a great sign. Prices stabilise, balance sheets become improved, and we've entered into this market that we've seen over the last 2 years, where suddenly the equity market's opened. There's been a huge amount of capital raised, both number of financings and dollar value raised. Obviously, that results in capital trickling down to the higher risk part of the cycle, the explorcos, which have been starved for capital. You tend to see a rush of small company financing as everybody tries to get on the bandwagon. And this is something that we're seeing right at this point in time, which is a low risk M&A, and Pretium is a classic example. As a cycle progresses, again, there's very predictable, stereotypical behaviour. You have more enthusiasm for the sector, capital raises, new discoveries. We had 4 arguably pretty spectacular discoveries last year with Rupert Resources, Chalice, De Grey and Newfound Gold. All of them have had exceptional performance. We've had less this year. Maybe that's because lack of market enthusiasm. I can think of a few that have done pretty well with Vizsla and its spin-out Vizsla Copper, for example, and also Predictive Discovery with its very rapid discovery to build out of a significant resource in Guinea. I think you need to start getting concerned when investors demand growth. This was the tipping point. It lasted, you were still in an upwards trending market for quite a long time, but when investors demand growth and companies see that growing their production or growing their ounces is rewarded, results in a positive share price, of course they very, very rationally rush out and try and grow their business. And the easiest way to do that is not to grow organically, although growing organically is the lowest cost way to do it. It's to acquire something, and that's when we start seeing higher risk M&A. Then we start seeing the other cheats that occur. Another way to grow your ounces on the book is to simply reduce your reserve price assumption and increase your volumes. This results in margin declines. You start getting moose pasture, very, very highly valued. So by moose pasture, I mean land that has nothing, that might be just close to a company that has something. Capital raises peak. Another quite negative sign. It was interesting in one of the presentations yesterday that they were focused on the fact that the generalists aren't in the gold trade. We don't want them to be in the gold trade yet, because when the generalists hop in mass, that's the last marginal dollar to come into our sector. So again, for me, that's a warning sign. This is bubble territory. This is when you should be frantically selling and possibly running away as fast as possible. Prices start to stabilise, they don't rise anymore. You start getting to see a frenzy on the M&A side as everybody starts to feel like they miss out. So high risk M&A explodes. And perhaps the most facetious one, but it's also true, is your taxi and Uber drivers start recommending stocks or start asking you about stocks if you happen to accidentally mention that you're in mining. So I think everybody in this room probably has a different view of where we are in the mining cycle. My personal view is that we're no longer at the beginning of a bull market in gold, but we're somewhere in the middle, and that middle period can last for an extended period of time. So, I jumped ahead on my good slide. So I think the aim of this presentation is to show that there are 2 parts to the investment decision-making process. I know that this seems very, very much stating the obvious, but as we've just shown, professionals in our sector really struggle with the sell side of the investment equation. So obviously the decision to buy and the decision to sell. I think we struggle with that decision to sell because there's a number of inherent biases that influence our selling behaviour more than they influence our buying behaviour. And I think if we can be aware of those biases and act in contravention to those biases and essentially do the work, i.e. your investments. There'll hopefully be less of this and more of this. Thank you. I was told to only do it for 30 minutes with 15 minutes of questions.
I think we got some questions from the audience. I think Philippe has some questions.
Otherwise, I'd have to talk to myself for 15 minutes. That wouldn't be good.
Yeah.
I missed, just a remark. I missed also in the presentation that we are underinvesting for 20 years in the mining sector because we had a hard time, especially 15 years ago. So we all know that a mine is not built in 5 years. Sometimes it takes more than 10 years with all the permits and things. So it's not a switch we can take on and deliver. So from now to 10 years ahead, we make more, we produce more, but it takes a long time to get all this production into the economy. So nobody hardly talks about that issue. And also in the cycle, I miss the investment of the management itself, because that's also for me, for my part, a decision which I make. The management doesn't
Have skin in the game.
stick any penny into the stock, only takes the money out. Then it's red flags for me.
Yeah, so I left that part out on purpose, just so people like you would bring it up in question time. No, look, I absolutely agree with you. The thing that you want to see is management has skin in the game. And sometimes I think there might be an unrealistic expectation from investors that they own, 5 or 10% of the company. Obviously, everybody's individual financial circumstances are really different. And so what might be meaningful to one person isn't to another. And so one of the things that I look for is, it's a sensitive question, but just to kind of get an understanding of what percentage of their net worth is exposed, how much do they really care. I would say, as a counter-argument to that, owning too much can sometimes be a very bad thing. I've seen one company in particular that has a very large shareholder. They have begun to reduce their position, but they have been a key problem in the inability of that company to extract value. Don't really understand the mining sector, enforce decisions on management, and at the end of the day have destroyed value. On your comment about the inelastic response to price pressure in terms of the supply side, absolutely agree. I think the average is now from discovery to production 15 years for all of those reasons that you just mentioned. But during the bear market, we had exactly the same supply-demand issues. I mean, we did a lot of work at this when I was working for a precious metals fund, and for us, the biggest decline in production, and we did detailed financial models on everything. I was basically a spreadsheet jockey. But for us, 2022 was a pivotal year because that was the year that you started to see a pretty significant decline in production without material growth. And obviously we've just come out of bear market where there has not been growth, and there's been the opposite. We haven't been investing in the R&D in our business. And so I think we're probably coming at a pinch point where you have the right environment for gold to escalate with serious supply side constraints. And as you said, you just can't simply turn the taps on. That's for sure.
Philippe.
General comment followed with a question. I don't know if you can answer.
Of course I can.
I've been in the business for 35 years, and this is mostly for the North American market. And for 35 years, you had a crowd that would follow, and that we actually educated. Okay. So I've been in business for 35 years, especially in North America. And for 35 years, we actually educated a specific group of investors, to appreciate the mining industry and the challenges that it presents. 35 years later, these people are 75 and 80 years later, and I believe they should switch their investments from speculative to more, because of the age factor. But 35 years later, our industry is faced with, competing industries such as crypto or cannabis, and now a generational factor, which is the millennials.
You say it like that. You say it like it's a bad word.
No.
It is.
Well,
I mean, did I say that?
And it's just an observation. Is the playing field is entirely different now, right? And we haven't done any work or any concerted effort educating the new breed of investors. And I think your presentation is excellent. But what do you do in an environment that we have been self-regulating because of BRIACs, because of the new ups and downs, and these new markets and these new investors? Well, what do we do to attract them?
Actually, I spoke with Michael about this yesterday. He very kindly did a bit of an interview on Kitco. Look, I actually think the gold industry, from the reputational side and how we manage that, it's structurally broken. What we're doing isn't working. I think maybe if you look at kind of the average demographic of a mining company leadership, and the World Gold Council, for example, they haven't really changed their approach. And we've had this bifurcation of the investors that should like gold, and that bifurcation has occurred with the advent of the cryptocurrencies. So, part of it is that we need to bring sexy back into the gold industry. And I think that is understanding how younger people look at the world. I know I, for one, I'm not on social media. I'm of a different generation. So the people who are in their kind of mid to late 40s, they're the ones that we don't really have a visceral understanding of how the millennials think and how they communicate and how they interact. And so I actually think one approach is, if I was running a company, I'd bring someone really young on the team to kind of understand how to penetrate a whole different group that we're not penetrating. I think also our industry has done an absolutely appalling job, not just gold, but the mining industry in general, of being proactive about mining being a foundation of life as we know it. Yes, you can choose to be a vegetarian, but you can't choose not to be associated with the products of mining. It's as simple as that. And yet the average person out there, if you ask them about, they might, I hate that, we should stop that today. And you know what, maybe we should. Maybe we should stop it for a week, just so the world understands where their stuff comes from. And so I think we tend to be reactive as an industry, not proactive. And so what we've seen with this movement on ESG, for example, and I'm a little concerned when I see a mining company present and they don't talk at all about their business, all they talk about is their ESG. And mining companies, ironically, were early adopters of ESG. They had to be, because you can't move your widget factory or your Amazon distribution center if you cause problems in your local community. We just didn't call it ESG, we called it CSR. So we have done an amazing job. And for instance, if you compare Amazon, an easy target, to gold mining, yes, Amazon might create some jobs in a local community, but they're generally very low paying jobs with terrible, terrible conditions, versus the mining sector that creates jobs that are generally much more higher paying than average. Now, if I look at comparing cryptocurrencies to the gold sector, I think there's a really interesting ESG argument that you can make for gold and against cryptocurrencies. Cryptocurrencies use extreme amounts of energy. They don't result in significant direct job creation. So if you look at the E side of the equation, the mining industry and the cryptocurrency industry, I think if you actually went down and dissected the CO2 emissions, for example, probably wouldn't be that materially different. Where the gold industry stands out versus the cryptocurrency issue is on the S and the G side. And I think we always forget about the S and the G side. Those of us that are invested in the industry and perhaps travelled and seen projects in developing countries, the impact even an exploration company can have on a local community, putting a water well into a village, absolutely fundamentally changes the life of normally the local women, and they're not spending 6 hours a day collecting water. Infrastructure, we often take the place of government, not necessarily a good thing, but infrastructure, job creation, direct taxes and royalties to the government, obviously, the taxes that employees pay, and then there's the multiplier effect of industries, and we know that's between 5 and 7. So every dollar of direct value created by a mining company results in an outflow of all those businesses that are created to support that mining company. So we do some extraordinary things. We're a fundamental, valuable part of society, but we kind of act like a battered, we're hiding, and we're not proactive enough about the things that we do well. So I actually think that there is a solution. I think there's a pretty obvious solution, But as I look around the mining sector, I don't see any leaders that are making the changes that need to change. And perhaps, if you've made a lot of money and your life is playing golf with your mates and flying private planes, I don't think you necessarily live in reality anymore. So I think it behooves our sector to have a visceral understanding of just how the average person thinks as well. And sometimes I think there's quite a disconnect between those two things. Sorry, I rattled on long enough.
Excellent presentation. I think we should put you on the World Gold Council because the argument you made is very convincing. Thank you.
Well, thank you.
So my question is different. I wanted to ask you, what do you think about, or your observations on why the Australian market has got so much better ratings in terms of valuation than the Canadian markets? Obviously, I know about crypto and all those things that you speak about, but in Australia, they seem to get it right. There's just so much more frothy, so much more, higher valuations. Why is that?
There's two things. I think you've had a bit of a golden generation in Australia, and the argument where you had a lot of producers with not the best assets by any stretch of the imagination, but on the subject of people were able to milk value out of those assets, the Northern Stars, the Saracens, the Evolutions, etc. The Canadian counterparts, for whatever reason, and I don't know what that reason is, they had the win on the currency side, etc., have been unable to do that. I think some stocks in Australia have very bubble-like characteristics just at a local level, and there's a key reason for that. Despite being a really small country of only 23, 24 million people, the way that the retirement system is set up, where you have forced savings in the form of superannuation. And so for such a small country, you have this incredible pool of capital that's circling and funds that can only invest, for example, in Australia domiciled products. So I think you have a captive audience that's forced to buy those companies. My observation, I feel like I can say this, I'm an Australian, is Australians are really parochial and isolationist in their view generally. And so companies that have assets in the country tend to perform, no matter what their quality, much better than companies that have assets outside of Australia. And I think Canada doesn't behave quite the same way, maybe a more global view. Australia's an island. We've seen how they've dealt with COVID. Haven't seen my mum and dad for 2 years. They've been stuck in Australia. So I think there's some unique aspects to the Australian market. On the positive side, Australians tend to put less focused on promotion and more focused on putting money in the ground, as this is a very, very broad generalisation. And for example, just on the technical side, things like I've seen Canadian companies that don't drill-oriented core, whereas Australian companies would generally be aghast at the thought of not drilling-oriented core, and that's the key piece of information that drives your ability to collect information about a deposit. So there's kind of I think a little bit of a difference in terms of the technical approach as well that leads into it. And Australians are guilty of, and sometimes this can be a bad thing, versus the Canadians, is they get a little resource and they go, we just want to get into production, and they tend to jump that development hurdle very quickly. WA is one of the easiest places to get permitted, one of the quickest places. I shouldn't say easy. But the timelines are very regimented and are in favour of advancing development and investment into the country, whereas in the opposite side, Canadian companies tend to defer those decision events. And so you have companies, for example, that have been drilling out their deposits for 4 years without a resource estimate. You wouldn't see that, I don't think, in Australian context.
Excuse me, What? Yes. My question is, do you know the central banks are buying gold? What is the reason? What do you mean?
I don't think you should listen to me. I think you should speak to the two keynote presenters that spoke yesterday. I sat in their presentations and they were superb. It's confirmation bias, but I absolutely believe the inflation argument. My husband and I, who's in the sector as well, we've been talking about it for the last 18 months. And they went through, I think, very, very good reasons why you're seeing shifts in central bank activity in terms of buying gold, and kind of quietly on the margin. And obviously they're concerned as well. We live in an environment where there's been enormous paper printing, and particularly as a product of COVID, and I don't know about you, but I just see it in everyday life, the cost of food, the cost of accommodation, the cost of fuel. And so for people who are living on the margin, these basic elements that they need to live, you're going to have energy poverty in the UK because of this move to green power, probably maybe with a lack of understanding of the implications around that, because you can only have certain types of power to supply baseload electricity. So I think you have a lot of uncertainty swirling in the world. Global political risk has increased. Inflation, I don't think, is transitory. And central banks are doing the rational thing. They're buying hard assets in the form of gold.
Thanks, Nicole.
Thank
We're
you.
out of time.
Okay, thank you very much.